Andrew Lowe's Adaptive Markets Book Overview. The book begins with a deep dive into traditional economic theories, particularly the EMH, which assumes that markets are rational, efficient, and driven purely by available information. Lowe highlights how the 2008 financial crisis exposed the limitations of these models, arguing that markets often behave irrationally due to human biases, emotions, and institutional constraints. He draws upon behavioral finance research to illustrate how psychological factors like fear, greed, and overconfidence influence decision-making in ways that deviate from strict rationality. Lowe introduces the adaptive markets hypothesis, AMH, as an alternative, arguing that financial markets function more like biological ecosystems than mechanical systems governed by mathematical formulas. He describes how investors, financial institutions, and regulators adapt to changing environments, just as species evolve through natural selection. This perspective explains market fluctuations, bubbles, and crashes as consequences of evolving strategies rather than mere anomalies. He supports this theory with extensive research from neuroscience, psychology, and financial history, demonstrating how adaptive behaviors emerge in response to competitive pressures, technological advancements, and regulatory changes. Chapters on risk management explore the implications of AMH for portfolio construction, emphasizing that traditional risk models fail to account for extreme market shocks. Lowe advocates for a more dynamic approach, incorporating machine learning, big data, and real-time behavioral analysis to improve investment strategies. He also addresses hedge funds, high-frequency trading, and algorithmic finance, showing how financial technology, fintech, is reshaping the investment landscape. The book concludes with a call for financial innovation and regulation, arguing that policymakers must acknowledge market evolution when designing economic policies. Lowe emphasizes the need for adaptive regulation that evolves alongside markets, preventing crises while fostering innovation. He also suggests that finance professionals adopt a more interdisciplinary approach, integrating principles from biology, psychology, and artificial intelligence to build more resilient financial systems. Key sections to focus on and why. Chapter 1-3, The Failure of Efficient Markets. Read this to understand why traditional finance models fail and how behavioral biases distort market efficiency. Chapter 4-5, Evolutionary Finance and Natural Selection explains how financial strategies evolve and adapt over time, drawing parallels with biological evolution. Chapters 6-7, Risk, Uncertainty and Adaptive Strategies critical for traders and investors who want to understand risk beyond standard models like VAR. Chapter 8-10, AI, Fintech and the Future of Finance. A must-read for anyone interested in algorithmic trading, hedge funds, and machine learning applications in finance. Chapter 11-12, Policy and Market Regulation essential for understanding how governments and financial institutions should adapt to avoid future crises. Final thoughts. Adaptive Markets is a must-read for traders, investors, and policymakers who want to move beyond rigid economic models and embrace a dynamic, real-world approach to financial markets. Lowe's interdisciplinary framework provides a more realistic, flexible, and actionable way of thinking about market behavior, making this book an essential addition to any investor's library.